Hey, everybody, and welcome. On Wednesday, October 25th, the Bank of Canada announced its decision to hold the overnight rate steady at 5% while continuing its policy of quantitative tightening. Globally, economic growth is moderating, with projections for 2.9% for this year impacted by factors such as the war in Israel and Gaza and changing economic dynamics in the US and China. Domestically, signs show that previous interest rate hikes are tempering economic activity, with Canada's GDP growth anticipated at 1.2% this year. Despite fluctuations in the CPI inflation rate, the bank projects it to settle at about 2% by 2025. The bank stands firm in its objection of achieving price stability for Canadians, indicating readiness to adjust the policy rate further if necessary. Joining our panel today, I can't wait to introduce you, buddy, is Jason Friesen, a seasoned financial professional who has managed over $1 billion in mortgage deals and is a partner with a reputable firm, Outline Financial. He is known for his customer-centric approach, emphasizing agility, trust, and top-notch service. Jason truly offers an unparalleled broker experience. We know that our clients appreciate Jason and his team, and we at Fox Marin work with him personally too. Jason's expertise, combined with Outline's ethos, ensures clients access to the best financial products tailored to their housing needs. We could not ask for a better guest to break down the Bank of Canada's announcement, hold, rate. Yes. My name is Ian Busher. I'm a broker with the Fox Marin team. Here is the Fox Marin broker of record, Ralph Fox, a good man to know, our analytical, investor-driven macro picture watcher. Over to you, Ralph. Over to you, Jason. Let's get this thing underway.
Ian, I'm so jealous of your voice. I can never do something like that. I can only aspire.
Thanks, Ralph. It's called a face for radio, I think is the term that they use.
Exactly. Well, I'm sure that's not the first time you've heard that. Anyways, so glad to have you here, Jason, on such an
Thanks for having me.
This day being the day the Bank of Canada came out and made its rate announcement. And thank God, G-O-D, that they paused. I think the harm that would have happened to the financial markets, to the real estate market, to basically everything, would have put a lot more people under a lot more duress. And I think we really just need to see these rates work its way through the system as it's doing. And it is seemingly starting to take hold. So it's just so interesting to me, having been in this business for, I don't know, I'm probably moving on to like 17 years and just seeing the importance right now of all of these announcements, and everybody's literally stopping, just watching to see what the bank is doing. And today was a really great example of that. The bank did pause. A lot of people, including I know myself and Ian, were definitely expecting it. But Jason, I'm just wondering from your perspective going into today, what were your expectations and were you surprised at all by the outcome?
No, I wasn't surprised. After we saw inflation numbers for the month of September come in lower than expected, I think it paved the way really at the end of the day for the Bank of Canada to sit on the sidelines, and they did exactly what most people were expecting would happen.
Okay. And, you know, the bank in its verbiage, of course, is leaving the door open to further hikes. However, if you've been watching what they have been saying and then doing, they don't have the best track record. Given that, just based on all of the indicators that you're seeing and having been in the industry as long as you have, if you were to guess, do you think, like some are predicting and or maybe hoping, but do you think that this is the end of this rate cycle for good?
Fingers crossed. I think they at the end of every press release just say, don't do something stupid. That's why they say they leave the door open for future rate hikes if needed. The month of November, we'll obviously have the October inflation numbers. We'll have job reports, and then we'll have GDP, the third quarter GDP. And then also on December 1st, we'll have November's job report. So all of these key pieces of information are going to be what the Bank of Canada will be reviewing prior to their next their next announcement on December 6th, which hopefully is not a hike. I think for the most part, if you look at what all the big banks are saying, and again, it's really going to be data driven, all the big banks economists are saying that they're done raising interest rates. Again, anything can happen. We could see inflation numbers spike. Anything could happen. But I think at this point, the expectation is that we are likely going to see the Bank of Canada sit on the sidelines. We'll see what happens moving into 2024. But I think to end the year, the likely scenario is that there will be no further hikes, that we can expect that interest rates are going to remain at their current level.
Just a quick, I just wanted to jump in quickly, Jason. Do you know off the top of your head or have it in front of you when the first announcement of 2024 is?
I believe it will be February. I can pull that up at some point.
So we're looking at probably about 60 days before we see another announcement again. Okay, thank you. Ralph, sorry I jumped in there.
No, feel free anytime. So given that the Bank of Canada has done what everyone, or the consensus was at least, they've met that expectation. Like, what impact do you see that having on the market?
Realistically, the expectation still is that it's not that, okay, we're done raising rates, but is it longer? Is it higher for longer? And I think until we see rates come down, there's still, it's having an impact just from the affordability with a lot of buyers right now. These higher interest rates, on average, borrowers are qualifying for about 30% less than they were in 2021. That's a pretty significant amount of purchasing power that's been eroded for most borrowers. But once we do see a signal that they are, and they kind of give more hints that they are done raising interest rates, I think that's when you'll start to see a shift. Because what you'll also see is you'll see a shift, you'll start to see bond yields start to come down at some point in time. So you'll likely see fixed rates come down in anticipation of the overnight lending rate coming down, whether that be kind of Q2, Q3, or Q4 of next year. And I think once we start to see fixed rates come down, that's when you'll start to see, I think in my eyes, a little bit more activity. We witnessed in March, April, when we had the SVB bank collapse, and, the conversation shifted that there potentially might be a rate cut before the end of this year. I thought that was ambitious and wouldn't happen, but the market started to price the possibility of that happening in. And we witnessed fixed rates fall below 5%. There were some cases where we had clients that were getting like 4.5%. And we remember, March, April was busy in real estate. It started to pick up activity again. So I think once we see fixed rates with a 5 or a 4 in front of them and not a 6, I think it will start to change the psyche of a lot of borrowers. But I still think it's very touch and go.
And if you were a betting man, when do you think, if that's going to happen, when that would happen?
So I think the market is probably pricing in that it will be a slower process to see the overnight lending rate start to come down. But if we track the big 6 banks, it's anywhere between 0.5% to 1.5% lower by the end of 2024, starting either in Q2 or Q3. Who knows if that happens, but that is the expectation based on where kind of the big 6 banks in Canada are forecasting rates. So at some point, fingers crossed next year, provided the data supports that.
Like, what are the conversations now are you having with clients? Are you seeing people being really nervous right now or cautious, or what is the typical conversation with somebody looking to purchase either a first-time buyer or a repeat buyer?
So yes and no. There is a section of the market that definitely is nervous. And I'm talking with a lot of past clients or current clients as well. And it's just, if you can hang on and not distress sell is the key. Can you make it to kind of end of next year? You know what I mean? Can you just hang on, and hopefully rates come down? With a lot of buyers, they're looking at it as an opportunity to get into a market that maybe has a little bit less competition, where it's a bit more balanced. We all know how the last several years have went. It's definitely been a seller's market. So for borrowers or buyers that are looking to get into the market, they have less competition, and they also have the ability to kind of shop around and make a decision versus looking at a house and having to decide if this is your forever home within 3 hours of looking at it, right? So I think that a lot of people are looking at this as an opportunity to get in with less competition. Even at higher interest rates, I think the conversation is that definitely most are looking to take advantage of either a variable rate or a shorter term fix, so that they can buy today at kind of a more manageable price, but then put themselves in a better situation in the near term, either by going short term fixed or going variable and watching rates go down, so that they can reduce their carrying costs in the near future. Obviously, there's a risk with that rates don't go down.
One of the jokes that we have in our office is it's an opportunity to buy a house that you actually like.
Yeah.
Because in other times in the market, you're just trying to get anything. And so now people actually can really get something that resonates a lot more impactfully with their long-term goals. And the other thing that you said that is just so, so true. If you can hang on, if you have a property You might be under a bit of duress, but you can still keep treading water. Keep treading water because this will pass. We're basically like using the analogy, like passing a really big kidney stone. And when we get to the other side of this, supply coming down the pipes is going to be choked. Demand is going to come back with a vengeance with all the people who are sitting on the sidelines now. And I'll say this again, I say it every day. I have never met anybody who sold real estate in Toronto over the last 20 years and not regretted it. So hang on if you can, because brighter days are coming. It's just hard to know when. And sometimes in the darkest days, it's hard to think of what the other side will look like, but it's definitely there.
You think it's fair to say the two best positions you could be in right now are being someone who doesn't have to make any kind of move at all, or someone who is buying and doesn't have to let go of anything to do it? I would say
Totally.
those are the two best positions to be in right now.
That's a great point, Ian. One of the considerations, it always was buy first and sell after. And now I don't understand how you as realtors, do your jobs, because the market is so in flux where a house could sell in 2 days and another one could sit for a month, right? So, I think the conversation has definitely shifted. Do I buy first or do I sell first? And I think if you don't have the means and, a worst case scenario mapped out that you're comfortable with, you've got to sell first, I think, is the reality of it, and know what your, cash position is, and know that, worst case, you stick yourself in an Airbnb versus being stuck with two houses. And, with interest rates this high, the carrying costs on two houses, it's through the roof. It's something that can bankrupt you, right? So I think the conversation has definitely shifted quite a bit, from previous years where you absolutely would be crazy to sell before buying, because you might be looking for a year before you find a place that you're even successful. Even if you found one you like, what's the odds of being successful, because there was so much competition?
Yeah, absolutely. The conversations we're having are a lot lengthier and a lot more about strategy, with the uncertainty that everybody's facing right now.
Let's plan for worst case, hope it never gets to that, but at least you're moving forward, making an informed decision. That's really what it comes down to, is, you're moving forward, understanding that your worst case is a possible reality. And if you're going to move forward, you're okay with that being the potential outcome.
Mm-hmm.
Very much so. The old adage applies, expect the worst and hope for the best.
Yeah.
Totally, 100%.
Toronto real estate more than it ever has in the past, for sure. A lot of the banks we were talking about earlier are talking about predicting that rates could drop as soon as the summer. And TD even has gone so far as to put out a report saying by 2025, they think there's a possibility by mid-2025 that we see interest rates back down to 2.5%. What are your thoughts on that? And how do you look at those reports right now?
The overnight lending rate, I assume, is what you're talking about, from 5 to 2.5. Yeah. And we were just we had Benjamin Tall as a guest speaker at an event, who said the same thing. CIBC is expecting by mid to end of 2025, the overnight rate will be 2 to 3% lower than it is today. I think that's welcome news. I mean, that, realistically, the Toronto real estate market, will operate well in a 3 or 4% interest rate environment, or even low fives. It's just this, kind of mid sixes, which, when you add 2% from a stress test rate perspective, and you're qualifying based on 8.5%, it's putting a lot of people on the sidelines. That brings me to a point. OSFI, which is the Office of the Superintendent of Financial Institutions, you remember at the start of the year, there was a lot of concern that they were talking about tweaking mortgage guidelines, and not for the better, making it actually a lot harder and more restrictive for people to qualify. And, the public consultation, industry consultation ended in April. We heard nothing. No one had any idea what was going on. And then on the 16th of October, they released their findings. None of the changes they were proposing are actually going to go through. The big ones were going to be limiting, the qualifying ratios, GDS and TDS, which are the two main qualifying ratios for mortgages, and having really strict guidelines on that. So they've thrown that out the window. So they're still allowing banks to, at their own discretion, lend. And then any review of the stress test, making it more restrictive, looks to be off the table. Now, the OSFI does meet once a year. So I think it's December 12th. They will revisit the stress test rate to see if it needs to be adjusted, but it doesn't look like it's going to be adjusted for the worse. I think they have just a set, kind of agenda where they do review, but I'm not expecting anything to make it more restrictive. So it's good that we didn't see that on top of these high interest rates, making the financing even more restrictive. It could have put the market in a bad place and put a lot of people in a bad spot. So I'm glad that they use common sense there.
Mm-hmm.
Interesting. And I know we asked this on our last call. I'm going to ask it again. Fixed or variable? Let's say you're buying a place today. Personally, what would you do?
Variable rate.
I think I would too. Ian?
Yeah, it's starting to look more and more attractive. That's for sure.
But again, not one size fits all approach, right? If you have a lot less, risk tolerance, the fixed rate gives you some certainty that the variable rate doesn't, even if it comes at a higher cost, in the short term.
Yeah. For some people, that's the only way they can sleep at night, is knowing exactly what they're up against every month. Yeah.
And what is the mentality like dealing with the banks, lenders, underwriters? What is their mood like? How are they treating deals? It seems like, from my limited perspective and some of our interactions, it seems like they're tightening and becoming even more difficult.
It's definitely much tighter than it was over the last few years. I think in part, the banks really staffed up over the course of the last couple of years. So they have, a large amount of people working in underwriting and not as many deals coming through. So they have the ability to do more due diligence. So I think you're seeing that. If you're a good borrower, you're still getting approved. There's a million extra steps you do have to take, even if it's a cookie cutter deal. I mean, we don't even see that cookie cutter deal doesn't exist anymore because everything, takes twice as long. It's those deals that are on the fringes, those mortgages that are on the fringes. So maybe someone with bruised credit, or they're self-employed and don't show a lot of income, that maybe used to get done at a bank are now being forced to go to alternative or B lenders. And then some of the mortgages with B lenders are now being forced to go private because they've tightened up. So I feel like it's, everyone's tightened up their policy. Even private lenders are less willing to go to higher loan to values. So typically, in normal times, you could get 80% loan to value. So someone would have to put 20% down if they're going private. A lot of private lenders don't want to go above 65%. So they want to make sure that there's at least 35% equity in a property. So we're seeing changes like that. Everyone is more risk adverse. I think that's just the reality of it. And if you are going to take a risk, you definitely want to be rewarded for it, because you can stick your money in a GIC and make 5% plus. Why are you going to give someone a mortgage at 7% or 8% and assume a bunch of risk? You know what I mean? It's got to be worth it for them. So it's got to be 10% plus. There has to be fees involved. So the private lending space, there's a lot of people that are definitely making a lot of money because there are a lot of people that are in a bad space, but it's not without a risk that those private lenders are assuming. That's for sure.
And are you seeing a lot of mortgage defaults happening?
No, I think the default rates are quite low. We were looking at a report that they're still at all-time low levels. We're not seeing anything crazy happening. I think that's really in part to the willingness of banks to work with borrowers. So if you're in a tough financial spot, reach out to your bank. They'll work something out with you. They don't want borrowers to go into default. I've never seen banks as willing as they are now to work with people.
Even more than COVID?
COVID, they did the deferrals, but now I feel like they're looking at things on a case-by-case basis and really putting, kind of helping people put a plan in place to keep them in their homes. Also coupled with the fact that a lot of borrowers have variable rates that are, kind of with fixed rate payments. So that's the consideration, is that, that's also protected a lot of the variable rate borrowers. So they're not really seeing a huge increase in payments. So I think that the combination of the banks working with borrowers and then fixed rate, variable rate payments have, kind of kept the default rates low.
Is it more the clients that you have that are selling? Are they selling because they're just like, can't take these hits and I'm just sort of done with it? Or are you seeing people selling truly under duress? Like, are you seeing people selling because they absolutely have to? Because we're not. Like,
Yeah.
conversations are like, it really sucks that we're having to carry this amount, and it's putting us under stress, and you can't go to can't go
The
to
tropics
night or whatever it is, or a nice game.
A few, like a very small amount of real estate investors that I think were probably not cut out to be real estate investors to begin with have had to sell, or maybe they found themselves in a situation where something else in their lives happened where they needed the cash. I've seen that situation happen where borrowers are feeling the pinch. Maybe it might be due to a loss of income, or kind of something that happened in their personal side where they've sold an investment property because there's a lot of equity in the property that kind of gives them some breathing room. Again, the conversation is to try to hang on because, to your point, I think if we're looking at this, 2 years from now, we're going to be in a worse spot from, kind of a housing crisis perspective. I think there are going to be, even more people looking to rent, fewer properties coming online just because of the number of new constructions that didn't take off, projects, take off over the last year. And so I think, if you can just hang on, just get yourself to the other side where rates do start to come down.
Amen.
I think you're going to put yourself in a better spot. I think looking back on this 5 years from now, if you, kind of pulled the chute 3 months prior, and then kind of rates do kind of signal that they're going down, you're gonna have a major regret, because I do see prices in the city. I'm definitely bullish on real estate, that's for sure. I think long term, medium to long term, regardless of what happens in over the next kind of 6 months, I'm still very bullish on real estate, especially in the city and in the GTA as a whole.
Awesome, and that gets me to one of my last question. Really, here is the real estate market right now is hypersensitive and affected by interest rates, the perception of where interest rates are going, and inflation, all of which are in your domain, with which you think about and deal with every day. So that having been said, where do you see prices from today where they could be in your mind as a guess, because everybody's guessing and everybody's wrong?
Yeah.
But where do you see prices, let's say 3 to 6 months from today? And then where do you see them, let's say 3 to 4 years?
I think we're going to see, as we see the amount of inventory creep up and it shift to more of a buyer's market, I think we're going to see some downward pressure on price. And then I think by kind of the midway point of next year, we're going to start to see that maybe the Bank of Canada has moved by then, or they've definitely given a good signal that they're done raising rates, and shift the conversation to when they'll start cutting them. And then I think from there we'll start to see prices take off. If you look over the last 10 years, compounded rate of growth, at least on a detached home, is like 7.9%.
Mm-hmm.
So when you're looking 2, 3, 4 years out, I think you're going to be looking at higher prices from a real estate perspective than you are today, and across the GTA. I think you're going to be faced with, I think you're just going to see, real estate prices continue to climb. Combination of, lack of inventory and a lot of demand is just going to continue to keep upward pressure on price.
Jason, is there anything else that you would like to add?
No, to my point before, I think, do what you got to do to hang on, and don't sell under, just because you're distressed right now. Try to figure out a solution, work with your bank. Is there a way you can refinance? Is there something you can do to just help yourself get over the hump? And maybe it does mean that you do need to sell, but just not in this environment. I think you wait and sell, if you can hang on a year, look at what the market looks like at that point in time versus, selling in kind of a bit of a time that's in flux, that's for sure.
Mm-hmm. Awesome. Ian?
Yeah. No, I was just going to say, it sounds like, the summary of that is your future self will thank you, right? For
totally
battening down the hatches and just weathering the storm if you can do it. I don't have any further questions for him, Ralph. How about you?
No, I'm good. I think we got a lot out of this conversation, Jason. And I'm so glad that you could join us on this auspicious Bank of announcement day. And we look forward with some trepidation to the next one.
Awesome. Thanks for having me. As always, take good care of you too.
Yeah, you too. In light of today's discussion and this recent report from the Bank of Canada regarding their decision to hold the overnight rate, we are grateful to have had Jason's expert advice and perspective. Drawing upon the bank's projections and the nuanced shifts in the global and Canadian economies, it's clear that expert voices like Jason's are invaluable to our viewers and to us at Fox Marin. If you haven't already, please hit that subscribe button. Don't forget to like us. Jason, once again, thank you so much for being here.
Thanks as always. I'm sure we'll see you again soon.